Great. Okay. Good morning, everyone. It is a great pleasure to be with you this morning, and a little bit of an unusual thing for a public finance economist who studies government taxes and expenditure to be here at the University of Chicago, because I have to admit that the traditional old view on government spending and taxes by the Friedman-Stigler generation was less of spending and grudgingly whatever taxes are required to cover that. Milton Friedman, of course, said that he thought one of the great mistakes of his career when he was working during World War II at the U.S. Treasury Department was coming up with the idea of withholding taxes, because withholding taxes made the collection of revenue so painless that people did not protest in the way that they would have if they were required to write a single big check every April 15th to the federal government. Okay, so that, leaving that view, which is the Chicago public finance approach, to the side, what I'm here to talk with you about this morning is the developing set of issues around government deficits and debt in the United States at a time when the IMF in the last few months has berated the federal government in the U.S. for fiscal profligacy, pointed out that we are running a substantial structural deficit at a time when the unemployment rate is 4% or lower, potentially destabilizing global financial markets over the longer haul. But of course, the U.S. is not alone, and we've seen a generally higher level of debt taken on by many countries around the globe as a result of fiscal changes during the pandemic, the global financial crisis, and to a little bit before. We are facing not just a fiscal deficit, but also a time deficit this morning, and I have agreed with Nell that we will try to stop quickly by 11:05 this morning. That will mean that those of you who'd like to ask questions about this, I'm afraid will have to grab me during the lunch break, but I am eager to do that and don't want to discourage that in any way. So, all right, so my goal this morning is to do three things. First, it's to tell you a little bit, for those of you who are not steeped in reading the documents of the Congressional Budget Office and following U.S. fiscal dynamics with the IMS Fiscal Monitor, where are we, what's changed over the last decade or decade and a half, and what does that suggest about where we are headed as we look out for 20, 30 years. Second, how do we think about the consequences of these higher debt levels and deficits? This is Parker's question a bit from before. I'll do my best to give you some answer. And then, what's the outlook look like? Have we ever faced challenges like this before? What's history tell us, and is the future likely to be like the past, and why might they be different? And I'll see if I can do all of that in about 20 minutes with you this morning. So let me start with a couple of slides that just show you the challenges of projecting debt and deficits as we go forward. Okay, this is a chart from the Congressional Budget Office in 1999. The U.S. was running surpluses at the end of the 1990s, and some of you may recall that we were having serious discussions about what was going to happen, given that the projection showed the U.S. debt to GDP ratio declining, that it wasn't going to be long before we ran out of government debt. And that was going to create a whole host of issues for financial markets, because Treasury securities were, of course, a bedrock of a lot of different things in financial contracting and capital markets more generally. And there were discussions, for example, about how the federal government could take the surpluses that would be then run and begin to invest in equities and do other things along those lines. Okay. Now, of course, if you run the tape for a few more years, these projections turned out to be inaccurate. And the federal government did end up owning equities in corporations, but for reasons in the global financial crisis that I don't think any of us had quite anticipated ex ante. This is the projection of the Congressional Budget Office today. What you can see is that period right around 2000, when we were on a sharp decline, reversed relatively quickly with tax cuts and spending changes in the early part of the 2000s. There's then a sharp upward jump in the debt to GDP ratio that takes place during the global financial crisis and the years thereafter. And it then continues with increase during the COVID-19 period. And the reason that looking forward here is so important is you can see that we are today at a level of debt to GDP around 100%. Okay, that number was 39% in 2007, and of course significantly lower at the beginning of the millennia. But the projections by the Congressional Budget Office suggest that we are heading for numbers around 150% of debt to GDP by around 2050 or thereabouts. And the key structural issue for the U.S. today is that the projections suggest suggest that unlike after World War II, when we did have high levels of debt to GDP, but we were running surpluses, we were running inflation, which ran down the debt relatively quickly, we were growing quickly, we're not in a situation that looks like that today. And in fact, if anything, the challenges run in the opposite direction for the U.S., which is why people, I think, get somewhat concerned about this. Now, some of you may remember that 15 years ago, team Ken Rogoff at Harvard, Carmen Reinhart at the IMF and at the World Bank, the IMF, and also at Harvard, had written a book on debt through the centuries, pronouncing that if you passed a debt to GDP ratio of 90%, that bad things started to happen in your economy. As I was saying to Amr, before during the break, it was sort of suggesting there was a waterfall. Well, we've gone past the waterfall and we're still smoothly sailing along, right? So the notion that there's a discontinuity at which terrible things happen, I think, has been somewhat rejected by the experience of the last couple of decades. But that doesn't undermine the basic economics of how the debt and deficit fit together in terms of thinking about macro policy. Let me show you the debt basically is the integral over time of the accumulated deficits of a country. So the way you end up running debt to GDP up is you essentially run deficits and then you add them up from year to year. This chart just shows you what the history of deficits has been. The deficits are positive above the axis here, and what you see, of course, is that back in World War II we were running 30% of GDP deficits for several years. You have to look at the experiences of both the global financial crisis and then the pandemic to see spikes which even show up on the same scale. They are smaller, and then as you look forward and see these continued deficits, the Congressional Budget Office here is projecting these under what's known as current law. Okay, so current law means that whatever statutes are on the books for fiscal policy are what the CBO takes as given. Now that means that the Tax Cut and Jobs Act of 2017, for example, expires in 2025, right? And that nothing happens to replace it. It also means that defense spending stays at currently legislated levels rather than potentially rising going forward. And it means that the child tax credit never reappears in some form. There's an alternative which is a little bit in the weeds of public finance academe, which is to try to replace the current law assumption with what we call current policy. Okay, current policy means assume that Congress will reenact things that they have tended to enact in the past, and that these kind of artificial cliffs won't actually materialize. If you were to do that, this deficit number would actually rise substantially faster in the future years. And the thing I will note, and it's a little hard to see with the brightness of the room, but the pink as opposed to the purple in this chart is the cost of interest on the federal debt. Okay, and one of the things that is notable as you go forward is that interest payments become a larger and larger piece of what the federal government has to pay. And the interest payments, of course, are the product of the interest rate times the amount of debt outstanding. And what we're doing is bumping up the debt, as you saw in the previous slide. What happened over the last 20 years was the interest rate kept coming down, which was helping us a lot, as I'll show you in a moment. But we may not be in that environment going forward as we think about where this goes. The chart I want to show you is to look at the level of interest payments by the federal government as a share of GDP. Some of you who followed this policy debate in the last decade will remember Larry Summers, Jason Furman, the CEA, Olivier Blanchard, my colleague at MIT and chief economist at the IMF, talking about in, say, 2018 or 2019, that concerns about rising levels of debt in the U.S. were somewhat misplaced, because it was true that debt to GDP was going up, but you really needed to look at the cost of servicing that debt. And interest payments by the federal government as a share of GDP were actually far lower than they had been in the 1990s and the early part of the 2000s. And that's because of the product that I just described. It's interest rate times the stock of debt outstanding. That point, of course, was quite well taken. And if only interest rates had stayed there, we would be in a somewhat different environment than we are today. But with an increase, and I'll just show you, this is the 10-year Treasury yield, which of course has jumped up from lows that were very below 50 basis points at some point during some years of the early part of the pandemic, but we're well in the 1 to 1.5% range in the latter part of the last decade. If you look out to something like the 30-year TIPS yield, this is the inflation-indexed real interest rate on long-term Treasury bonds that pay you an inflation adjustment plus an interest rate. This has gone from a negative number 5 years ago to numbers that are today on the order of 2 to 2.5 percentage points. A shift of 250 basis points in the interest rate, the long-term real interest rate on U.S. Treasury debt, is monumental in terms of the burden of a high debt to GDP ratio, and that's part of what is driving the kind of alarm bells within the fiscal policy community today. And the arithmetic on this, by the way, is pretty easy. Because when the debt to GDP, I teach at MIT, and we have a pretty quantitatively literate undergraduate population. But things like what I'm about to describe are helpful to keep in mind as you think about these numbers. Right? When you've got a debt to GDP ratio of 100%, if you raise the interest rate by 1 percentage point, you increase interest payments over GDP by 1 percentage point. Right. So that helps you think about what this is doing to the deficit, right? Which is a 200 basis point move in interest rates is like a 2 percentage point of GDP increase in the deficit that the federal government has to cover. And of course, the interest just has to be paid, right? The Congress can't legislate that it's going to cut the interest payments, whereas it can tackle, not discretionary federal spending, and maybe it could someday, but not anytime soon, tackle entitlement programs. But those are all going to be additional challenges. But the interest is there, and of course, is a market-determined price multiplied by the legacy of what's been accumulated in the past. So that gives you some idea, I think, of how we got here, right? It's a combination of rising interest rates in the last couple of years, plus the spending of the global financial crisis and the pandemic, and a sort of lack of political commitment to running surpluses in times when the economy's been strong, to kind of store up some dry powder for the times when it's going to be weaker. So ultimately, to come back to some things Luigi said in his remarks this morning, a lot of this has to do with political economy and not economics. I can describe the economics for you, but I can't really handicap what might happen in terms of the politics as we go forward. So let me then ask the question, which really comes to Parker's question, which is this a burden? How do we think about this larger debt stock? Many of you probably heard the old saw, we owe it to ourselves. So how can the debt be a burden if we just owe it to ourselves? It's just a matter of transfers within the economy. Well, first thing is it's not just transfers within the economy, because a quarter of our debt is owned abroad. And therefore, we do actually have to pay that quarter of the interest to foreign investors who are holding the bonds. And that's a net transfer away from the U.S. The second thing, and to come to Amar's earlier comments, even if we owe it to ourselves, the owners of the debt and those who are responsible for paying off the debt are different people. It's taxpayers versus households that own bonds, or pension funds that own the bonds, and whatever. So the notion that we could just say, poof, we will default on the debt without any consequences is very different than doing something within your household with your kids, where you're saying, you owe me something, but your allowance is coming along. So how about I just say we won't pay you the allowance this week, and we'll be kind of all done, right? It's not a sort of simple within transfer. This has some real consequences that are quite important. But I think the real, if I was going to leave you with a little bit of undergraduate, intermediate macroeconomics this morning, the real way we think about the burden of the debt is that the debt securities are financial assets which are held in the portfolios of investors like households. And when we have a lot of debt and that debt has to be held, it crowds out other investments which could be made by those households. So, Bill's discussion of where the VC industry is finding its capital, if I'm sort of stocked up on a lot of treasury debt in my portfolio as a pension fund or an institutional investor, I'm not as eager to come out and invest in a Warburg Pincus fund or something else which is going along. And it's consequently, the debt pushing up the interest rate on these securities and then crowding out the other investments that might be undertaken, which do have productive consequences for the economy, right? Buying treasury bonds does not lead to new investment ideas. It does not lead to new businesses being created. And it is that margin, in some sense, where we think of the ultimate burden of the debt kicking in. Now, the question then you might ask is, well, all right, you'd say it matters for interest rates. How much? Give you another little rule of thumb. Congressional Budget Office thinks basically that if you raise the debt to GDP ratio by 10 percentage points, that will increase the interest rate by about 0.3 of a percentage point. Right? So, that would say that if we run up the debt to GDP ratio by 30% since the latter part of the last decade, maybe that would, under their thinking, add about a percentage point to the interest rate that we are paying. Now, I think this is where Parker's question kind of comes in, which is, so what does that mean? Right? Well, it probably means that we're putting some upward pressure on interest rates. I don't think it means that we're going over a cliff in which the economy suddenly becomes different because we have this higher level of debt. But it does have some real consequences for capital markets and ultimately for the productivity of new investments. And it's simply because the hurdle rate that investors looking at other projects are going to be demanding will be higher in a world where they can earn this much more on Treasury rates. Now, I want to be very clear, and I'm going to channel the humbleness of the first panel this morning, which I think is really important for economists to embrace. Interest rates have moved a lot more down and then up than any of the simple arithmetic around debt would suggest. Okay, and that's a very important reminder that a lot more is going on when you try to think about the determination of interest rates in the Treasury market or other markets than simply supply and demand of Treasury debt. Right? And whether you say, this is global geopolitics, this can be flights to safety at various points, it's all out there and it's all got something to do with what's grinding out these interest rates and prices that we see. Okay. But if you're just trying to do the, ceteris paribus, holding everything else constant, what would you try to think about it? You would think that this is basically a force which is pushing us up a bit in terms of the interest rate that we see. The Congressional Budget Office, basically, when it does the projections that I've shown you, they basically forecast that interest rates for the next 30 years will stay about where they are today. Okay. Now, I wouldn't want to hazard a projection about long-term interest rates, but I'd be willing to take the side of the bet that says that this probably won't be exactly what happens as we go forward for the next 30 years. Right? Just don't ask me to tell you whether it's going to be up or down in doing it. But it gives you, I think, some sense of what we're looking at in terms of the drivers of all this. All right. One last number I want to leave you with in terms of thinking about this gap that we've got. Think about the following hypothetical. Okay, magically, Washington policymakers, whoever they might be, comes to the group of economists at the CBO or others who are in the business of looking at these long-term projections and says, we're concerned about that first chart, right? We want to make it flatline instead of keep going up. And our past sins are what they are. We've got 100% debt to GDP ratio, but at least let's stop making it worse. Okay, so what do we have to do to keep debt to GDP constant so that by the time we get to 2054, 30 years out, or doing our forecast, what do we have to do to get to 100% of debt to GDP in 2054? Okay. Well, the answer to that question, if you're using current law, TCJA expires and all else, you need to increase your taxes relative to spending by about 2.5% a year, starting now and doing it in every year for the future. Okay. 2.5% of GDP, 2.5% of GDP, right? Very important reminder. If you do it with current policy, right, with whatever spending we think Congress might decide to enact, it's much larger. It's about 3.7% of GDP. Okay, so that's the gap you've got to try to close. And we're not hearing much from our policymakers that suggests a focus on closing that gap. Okay, and that's that's disheartening from the standpoint of the basic economics I'm describing here. But I think the question I want to close with is well, could that happen? Right? Is it sort of out of the realm of possibility that we might be able to do that? And let me share one statistic on this that I think you may find interesting. If you look at the period 1992 to 2000. Spending relative to taxes in the U.S. narrowed by 6.8 percentage points. Okay, and now how did we manage to do that? Okay, well, several things happened during that 8-year period. Okay, one is that defense spending as a share of GDP in the U.S. declined by 2 percentage points. And I was fascinated by the last panel and wondering how much of that came out of cutting DARPA and other things like that, and how much of that came from closing bases. And it's some of each, but 2 percentage points of GDP just on the post-Cold War, we managed to shrink the defense budget. I don't know about you, but I'm not too optimistic that we've got cuts in the defense budget lurking ahead in at least the next few years in terms of where we stand. Second part was receipts, federal tax receipts as a share of GDP rose by about 2.5 percentage points. And that was a combination of putting in place in 1993 a more progressive tax schedule than we'd had before, with higher rates, not just at the very top, but higher rates. And then keeping it in place as rapid economic growth during the 1990s generated more revenue with that tax system, okay, and allowing the tax to GDP ratio for the federal government to drift up relative to where it had been historically, okay. And the last part of this was actually cuts in discretionary federal spending, which drifted down during the 1990s by several percentage points. Okay, so taken together, this gets you to a structural adjustment, which is larger than what we need to put in place for the next 30 years to be able to flatline the debt to GDP ratio. Okay, declining interest rates also help a bit, right? Because that lowered the burden on the debt to GDP. But remember, when you start with a lower debt, the decline in the interest rates helps you less than it would today. Okay, so lower for longer today is more important than higher for longer today is in terms of understanding the consequences of debt to GDP dynamics. Okay, where does that leave us today as we look to the future? Well, I've mentioned that the defense spending to GDP ratio doesn't seem poised for another big decline as we go forward. What about economic growth? Right? When we try to handicap growth, and I very much want to say that the last panel and the possibility that something exciting happens technologically, whether it be AI or otherwise, pushes us forward is always something that might occur. It's hard to forecast, of course. You wouldn't want to bank on it. But when we look at the changing rate of population growth in the U.S., immigration is an important flywheel in that calculation because immigration can raise the size of the U.S. economy and let us continue to grow. But combination of aging population, fewer younger workers coming in, we know that's related to rates of entrepreneurship and other things, doesn't look like when people try to forecast economic growth for the U.S., the numbers will rival where we were during the 1990s, let alone some of the earlier decades. So we're probably in a slower growth period, which makes it hard to bank on that helping us to get the debt to GDP ratio down. We have an aging population, and a very significant component of what the spending going forward is the combination of Social Security, Medicare, and Medicaid. And that's difficult politically to touch, and it's kind of baked into the system. Now, if we had some of our health economists experts from this afternoon's panel willing to jump in on, the U.S. is an expensive place to buy health care. It's also a place where the healthcare bundle we get is pretty good, at least for some part of the top end of the distribution relative to what you find in the rest of the world. So thinking about how we might change the amount that the federal government spends on medical care is a very deep and challenging issue. Maybe there's some wringing out of spending to be had there, but it's been pretty hard to find it along the way. And the aging population is just another headwind, which is just going to push us toward higher spend, not lower spend. And again, it's something which is very difficult to undo. So I think all of those factors suggest that it's going to be difficult to find spending cuts as we go forward, which leaves you thinking about taxes. And then the question it raises with you is, well, how and what could we do to raise taxes? Designing an efficient tax system which can raise revenue is kind of the bread and butter of what public finance economists that I hang around with like to think about. But it's difficult to do that when you start to constrain the system to say we can only tax some part of the population. And the U.S. personal income tax at the moment is very strongly progressive. Okay, the top 1% is paying something on the order of 45% of all the income taxes in the U.S. The bottom 50% is paying almost nothing. That's the income tax, not the payroll tax. And I had to get into a discussion about how those different components fit together. But the U.S., if it were to adopt, say, a value-added tax that would follow the Western European model or virtually every other industrialized country model, there's a lot of revenue that could be had there, but it's a very big step and something that probably is not not something our political economy is ready for. So then that pushes you back to, what kinds of reforms can you make by, broadening the tax base a bit, trying to, make some repairs. And there are some big levers one can pull, taxing capital gains, for example, at death by suspending the step up of basis at death, and thinking about other changes, that one could make to the broad rate structure can certainly raise revenue along the way. But it's going to be a kind of, a line by line of the tax code battle if you go down that route to try to find these revenues. So I think where that leaves me is thinking, it's not that we're about to fall off a cliff with the level of debt accumulation we've got, but we'd be remiss not to think that we are on an unsustainable path, and that the longer you stay on the unsustainable path, the harder it is to get back on a sustainable path and at some point in the future. So all the numbers, the 2.4%, the 3.7% of GDP, adjustment in spending versus taxes you need, they are they're bigger numbers if you start in 2030 or 2035. And that's, I think, the imperative that suggests we need to be thinking about this today. Doesn't seem to me like we're going to dramatically transform the economy from this, but I do think that we're in for a period where the fiscal headwinds here are pushing us toward higher interest rates and ultimately towards some crowd out of other sectors of the economy. So let me stop at that point. I hope this has been intriguing. I'd love to talk more, but I'm trying to do my best to keep Nell on schedule. So thank you.